Good day everyone, hope you are well. Today we will look at Chapter 9, Forms of Ownership. This is Unit 2. We will be looking at partnerships. Choosing a form of ownership. Extension of sole proprietor. This is when two sole proprietors basically gets together, two or more, and they decide we are going to work together on the same type of business. We are going to form a partnership. So 2 to 20 owners. Share responsibility, financial and management decisions. So the load of responsibility is less on you. Partners jointly decide on operations and management and marketing processes. Each partner contribute capital, capital goods, skills, knowledge. In return, they share profits or losses. Right, so partners will jointly reliable for legal and financial or ethical problems, which is great because you're not responsible for 100% of these problems, only your part of the partnership. Okay, so discuss issues, concerns, and strategies together and make decisions together. That is better as well because now you're not based on your decision and your opinion alone. So you have greater wisdom between a larger group compared to only one person. The problem with this now is it takes longer to make a decision. Okay. Right, so allows more diversity and specialization, as in the previous point I mentioned, more wisdom between more people. Right, so responsible for her own tax. So you will earn money from this partnership to the percentage that you earn of this partnership, and you are responsible for the tax on that part. Cover losses from own funds. So if the partnership were to make a loss, you will have to cover it from your own funds, only your part, luckily. Okay, so no legal requirements to register for the register of companies. Since it's not a company, same as with a sole proprietor, it has no legal entity. It's not a separate legal entity. Need to have a partnership or a partnership agreement. That means that it's just an agreement between you and your partnership put on a document where you guys sign, and that is the day when certain decisions needs to be made. Depending on the situation, you will refer back to the partnership agreement on how to treat that situation. Common amongst doctors and lawyers. So a group of doctors will form a practice. That practice will be known as a partnership. Lawyers, same. So you might have a lawyer that specializes in property law, another one specializing in tax law, and when they come together now, they have more knowledge. Right, advantages. So you put your knowledge and skills together. It's very cost effective and you don't need outside expertise. It is cost effective because you don't have to pay someone from outside to provide consulting to you, right? So no consulting fees because in most cases you have all of the knowledge that you need. Also, workload and responsibility are shared between partners, sharing pressure, time, and effort. It takes a lot of pressure off you, not to take 100% of all of the responsibility and workload. You only have to do your part. Share resources such as startup capital, expenses, and services, which saves cost and all allows more greater profits. This means that more people are putting money into the business, which means your business has a better chance of succeeding because it started out with a greater amount of capital. In other words, you have more options. Also, you do share the profit now, but the profit is greater. So even if you only get 20% of the profit, that 20% in most cases will still be greater than the 100% when you were alone. Right, so only required to pay tax in own individual capacity on profits earned from the business. So you're not responsible for the whole partnership's profits. You are only responsible, let's say you own 20% of the partnership, then that means you are only responsible for 20% of the taxes. Have a personal interest in the business ensures that the business achieves aims through good management and leadership. Because each partner has their own personal interest in the business, they will make sure that they will work to the best of their abilities in this business compared to someone that does not care. Should they need additional capital, they can bring in extra partners to fund requirements. So if you are only 5 partners, but you need more money, you can get more partners if you want to expand your business and need extra money or capital to do so. Attract positive employees. Option of becoming a partner. So if you employ people and you see, well, this person has a lot of knowledge and will be a benefit to the partnership if they become a partner, then you can make them a partner and they can buy in. In other words, they will buy their part and you can use that money to expand your business. Disadvantages. Partners' personal savings at risk. So that means that if the business fails, the partnership, if they make a loss, then the government can come after your personal assets. All partners jointly responsible for joint liability, same as the previous one. If the business can't pay their debts or liabilities, they can come after your personal stuff. But also that means that if the company borrows money and you own 20% of the partnership, you will need to repay 20% of that liability. Different views of partners can lead to conflict and destroy working relationships. So if one partner wants to do something and the other partner wants to do something else with regards to how the business is run, then it can lead to conflict compared to when you were a sole proprietor and you were making the decisions alone. Partners may not all contribute equally. Breakdown of skills management. So in other words, let's say one guy does not have all of the knowledge of the other partners, then he can't contribute that much, and that might make it a bit more difficult because then some partners are going to bring more to the table, in other words, work more because they have more knowledge compared to other partners. Loss in profits and stability of business can occur if partner resigns, dies, gets bored, or is declared bankrupt. So let's say one partner unfortunately passes away, then that leaves a gap in the business. You need to get someone with the same expertise as that partner. It will disrupt your business or your partnership in a bad way. There can be a lack of capital and cash flow, even though there may be many partners.